Hey guys, Daniel here. Thank you for tuning into this video. In this video, I just wanted to go over my checklist for looking at companies that are selling below tangible book value. So, as value investors dealing with smaller amounts of capital, like let's say less than $1 billion, we should be definitely looking at the smallest possible companies because that's where the greatest inefficiencies are going to be in terms of price. In terms of my own personal screening for companies that are selling below tangible book value, I tend to start off obviously with just basic screen like okay, which companies in the universe of stocks are selling below tangible book value, like let's say 0.75 or lower, and then I exclude certain sectors like financial, and I also exclude headquarters in certain regions, and so I try and start off with that, just a very basic screen. Then I go through those companies, on a regular basis to see if anything new is there. And then when I find things that interest me and meet certain of these criteria that I have listed on the screen, then I do a further analysis, and we'll look at, read their 10Ks and listen to some earnings calls and so on, and try and figure out what's going on with the company. So the first thing I ask myself is the company selling substantially below tangible book value? So I don't use book value. I like looking at tangible book value because I like looking at the actual tangible assets of the company. So that's basically book value, but not counting things like goodwill and other intangibles, obviously. Those you just value at zero because it's the most conservative way of doing it. So rather than comparing price to book value, you should be using tangible book value, in my opinion, to be more conservative. And I'm looking substantially below, so at least a 30% discount off of tangible book value, if not a 40% discount. Once that happens, once I find companies that are selling for substantially below tangible book value, I ask myself, why is it being sold for so cheap? So I try and look at the news, and I try and look up news on the company to see why there was such a sell-off, if there was a sell-off, and usually there is. Sometimes, most of the time, you'll find that there's a good reason why it's selling for below that. There could be massive upcoming lawsuits or other things going on, and that could be an indicator that you just want to sort of stay away. So I try and figure out why, and if the reason why isn't obvious, then I'm even more interested, because there should be an obvious reason why the company's selling for so cheap. The other thing to consider, though, is if we're talking about companies with market caps of like 50 or 60 million, definitely less than 100 million, there just might not be that much public information on there, like on the news, because the company's so small. So that's something also to keep in mind. But so you got to really dig in a little bit. The next question I ask myself is, do I understand how the company makes money? I mean, I think that's pretty straightforward. I got to look at the industry, and I got to look at basically the company's, report in terms of how it says it makes money and what it does. If I struggle to understand what the company does and how it actually makes money, then I'm just simply not interested. It's outside of my circle of competence. I also ask myself, is the company burning through money? This you could usually see. You just look at basically the history of the revenues, the net income, the retained earnings of the company, and you look at, okay, what rate is it actually making money? Is it actually profitable, or is the tangible book value falling year after year? If it's falling substantially year after year, then you're probably going to want to stay away. I'm looking for steady increase, at least increasing tangible book value. I'm not looking for situations where you're buying in at a tangible book value here and the price is here, but the tangible book value is going down, and you're hoping that the market will correct the price before the tangible book value goes to basically nothing or negative. And that's what I don't want. I want the tangible book value to be steadily increasing over time, and the company to have decent prospects in terms of making money in the future. And that's basically the next point, right? Is it fairly stable or falling? If the book value is falling, I'm just not interested. And that usually has to do with debt too, right? If debt payments are going to go up substantially over the next few years, again, I'm not interested. And if the company's over levered, again, I would just choose to stay away. And whatever ratio you feel works for you in terms of times interest earned and debt to equity and so on. I mean, that's really up to you and what you're comfortable with, especially how the debt itself is structured, I think, is more important than anything else, and when it's due. So those are some things definitely you should be looking at as well. And a very important question, and I think it's overlooked maybe sometimes, is are the tangible assets actually real or fake? Just because they're reported on the balance sheet, or just because you see what the tangible book value is, doesn't mean it should actually be that. And I'll give you an example. Sometimes companies, most of their assets are in inventories, and those inventory values may change over time. And sometimes the companies don't necessarily write off things as well as they should. So if you think about it, like you might have a company that has $1 billion worth of T-shirts, but they're World Cup T-shirts from last year that are now basically worthless, and they didn't mark it down appropriately. So those are some things to keep in mind. Sometimes the reported inventory valuation it can be way off. So you got to know exactly what the inventory is made of. If it's made of more raw materials, like the further behind in the manufacturing process, the more that inventory will tend to be worth. So if you're dealing with raw cotton, it's one thing, but if you're dealing with last year's World Cup T-shirts, it's basically completely probably worthless unless they actually marked it down and you're still above or you're still substantially below tangible book value. And then you should look at also if it's concentrated in a single line item. So if you got a lot in, for example, the inventory, and a lot of the asset value concentrated in the inventory, you should be suspicious. Properties, plants, and equipment is a little bit better, usually depending if it's in land. If it's in real estate, then that's one thing. But if it's in specialized equipment, you should be a little bit cautious in terms of valuing at what it's reported at. Another thing I like doing is looking to see if the price has shown some resistance in the past when it falls below tangible book value. You can look at the historical price of the company and overlay that with the historical tangible book value and see if over the course of the company's history, one, that book value is relatively stable and increasing, and two, when there are instances where the price falls substantially below there, it recovers, right? So what we don't want is a company that's selling, half of its tangible book value, but it's been doing that for the past 10 years. I mean, that's just not interesting to me. I got to see some chance of, recovery to the, to the low point of the intrinsic value, at least, over the course of the company's history. And then, of course, the earning power. So we want to make sure that the company is actually making money. I'm not interested in buying into companies with negative retained earnings that have lost more money since their inception. So I think it's important to look at, okay, does this company make money? If so, how much does it make, and does that earning power support our tangible book value at least, right? So those are the things that I would look at. I can show you here quickly a list of companies that I'm currently screening through. You can look at them quickly here. Some of the numbers that I try and pay most attention to is obviously the price to tangible book value. I look at the average 5 years earnings divided by the current price. It's another thing that I look at, and I try and look at some basic balance sheet metrics in terms of its leverage, what its return on capital is like, and then obviously its market capitalization, its retained earnings over the course of the business, and also the tangible book value. So those are some basic numbers that I look at. And again, I encourage you, if you're dealing with a smaller portfolio and you want to get really good returns, the best way to do that is to look at companies that are selling for substantially less than their tangible book value, and being able to buy those companies at huge discounts to what they're conservatively worth. But there are some cautions that you need to look out for, some warnings, and one is going to be obviously negative retained earnings. So stuff like retained earnings, stuff like where it's negative here is basically sets off a red flag for me. So stuff like that, and keep in mind this portfolio here is not something that I'm necessarily investing in. It just this got to a certain point in my screening process. Obviously, I have to investigate much further. So, and you obviously have to do the same if you're going to invest. So, always be willing to dig in deep and see where the actual worth of the company is, and if it's actually worth what they say it's worth. So, yeah, that's the video. Thanks for watching, and if you have any questions, please leave them in the comment section down below.